Hello, this is Paul Harris from Mining Journal. Today, I'm joined by Adam Davidson, CEO and Executive Director of Trident Royalties. Good afternoon, Adam. How are you today?
I'm good. How are you?
Very well, thank you. Trident Royalties is a new kid on the royalty block, so to speak, and it's the first junior royalty company to be listed in London. And you've got a very different and diversified approach compared to traditional precious metals royalty companies. Tell us a little bit about Trident and what makes your approach so unique.
Yeah, sure. So yeah, as you mentioned, we're listed in London, which probably makes us unique in our own right, because our only other currently listed mining royalty company in London is Anglo Pacific. But as you've probably seen, Wheaton has announced that they're going to be listing dual listing in London as well. And then the Ghanaian gold royalty portfolio has flagged that they'll be seeking an IPO in London before the end of the year. So London seems to be picking up a bit of steam with regards to the mining royalty sector. But yeah, what makes this unique is that we're looking to build a diversified portfolio of mining royalties, effectively a portfolio that would be broadly reflective of the sector as a whole. With the thesis being that you can extol the virtues of royalties, and I think our precious metals peers have demonstrated that that can resonate with the market. But then the next natural question is, if an investor likes the royalty approach with regards to getting their mining exposure, where can they get the full exposure to the full suite of mining commodities? And that's what we're looking to offer them, is something that's reflective of the sector, effectively being about a third precious metals, a third base metals, and a third bulks and battery minerals and everything else, which is roughly the breakdown of the mining sector as a whole. So that way an investor can hold a single share of Trident and have, from a royalty perspective, the exposure to the mining sector on a broad, diversified basis. And as a growth royalty company, I think, as you said, there's nobody else out there doing that at the moment, and so a wide opportunity set for us.
Okay, I mean that's quite a broad investment thesis. Precious metals, base metals, bulk and battery metals, and you've already started to implement that with your initial transactions. Can you tell us a little bit more about those transactions, please?
Yeah, sure. So we've got a paying iron ore royalty, a paying copper royalty, and then six now precious metals royalties. One we just announced last week over the Lake Rebecca project in Western Australia is a royalty over a 1 million ounce growing deposit that we see as having scale to grow, and will be in production in the near term, near to midterm. So in regards to that third allocation, we're already roughly there, sort of unintentionally, because we came out of the gate looking for just the most accretive transactions we could find, but have found ourselves with roughly hitting that breakdown when you look at it from the price of each transaction. So yeah, we've done 5 transactions, over 8 royalties, 2 that are paying. Should be generating relatively substantial cash flow. You can look at our iron ore royalty and what it's paid through July this year, so about 1.4 US at today's exchange rate, sort of just about $1 million US for half a year. And then our copper royalty has a minimum payment schedule of $375,000 per quarter next year, and then that increases to $500,000 per quarter in 22, and then increases again to $750 per quarter in the first 2 quarters of 23. So you can, and obviously they intend to exceed the production profile that would meet that minimum. But just from those numbers, I think you can start to put together what our revenue profile is going to look like, and that's from the first 2 paying royalties. And then, as I said, we've now got 6 development or exploration stage royalties. A couple of those are tangibly moving towards production, and still have cash in the bank and the debt capacity that we could potentially draw on. And then, our listed equity that now that we're up and running and have a bit of traction, vendors of royalties are finding that more appealing. So we've still got a good amount of capacity to go out there and get more royalties into the portfolio.
Thank you. You debuted on AIM in June with a £16 million initial public offering. You've obviously spent some of that already, bringing in the portfolio of royalties you mentioned, and some of those are cash flowing. So it sounds like pretty much right off the bat you're going to be revenue generating, which is obviously the end game. But to what extent will that help and facilitate the acquisition of additional royalties going forward?
Yeah, I mean, it does quite a bit for us, as you can imagine. I mean, the ability to be cash flow positive and have that cash coming in on a quarterly basis unlocks, things like getting debt capacity. You can obviously do it from a standing start where you're getting debt against a specific asset that's cash flowing and sort of do it that way. But it's much simpler if you can come in and sort of say, we're already generating positive cash flow, and and now we want to draw some debt for XYZ acquisition. Yeah, that just makes that conversation and the cost of capital much cheaper than to get access to that debt. So, that's one key consideration. That, and I think investors obviously don't want to see a company raise capital and then sort of chew it up through G&A. We'd secured our Kulinaubing iron ore royalty and closed on that the day after our listing. So it was effectively secured with the cash that was sort of sitting in the Trident shell prior to our listing. And then that asset more than covers our G&A for the foreseeable future. So really with that capital we raised, we're able to go out there and fully deploy it to build out the portfolio. Because as you know, royalty companies, it's all about critical mass and getting that diversification. And that's what leads a royalty company to be valued higher than mining equities, is the fact that you have this risk mitigated approach where you're getting all the asset exposure and the top line revenue exposure, so the direct commodity exposure effectively. But you're doing so from a diversified portfolio of assets. So building critical mass is sort of the key hallmark of a royalty company. And so we're conscious that having the capital to do that is one of the key considerations. And, debt, the cash on the books, the ability to use equity, we've got a lot of tools at our disposal in that regard.
Okay, thank you. Now, you've already mentioned a bit about the commodity diversification strategy, but you've also got a geographical diversification strategy. You mentioned Australia, you mentioned Africa. What kind of advantage does that give you, spreading the net very broadly in terms of geography in order to seek out the royalties?
Yeah, I mean, well, to be honest, you don't have to look too much further than just our first two transactions that we announced. Iron ore in Australia, copper in Zambia falls sort of well and truly outside the purview of the North American listed and focused precious peers in the space. So if we were looking at a Nevada gold royalty that was paying, it would be a dogfight to try to get an asset like that, and yet you'd have to pay up for it. But these sort of assets that we're finding, as I said, it sort of all comes back to the original thesis and strategy of Trident, which is to find a diversified portfolio and agnostic with regards to geography. Obviously, it needs to be in a geography that is suitable for royalties, that has the proper legal framework for them. But yeah, there's no shortage of opportunities if you're willing to look outside of sort of that narrow commodity and geographic focus of most of our peers.
Okay, and what does being off the beaten track mean for deal availability and acquisition costs? You mentioned that if you're pursuing something in Nevada, you'd have to fight for it, and I imagine pay much more for it as well. We're going into the other geographies where there's less competition. Does that make the deals cheaper as well?
Yeah, no, it definitely does. Yeah, I mean, I think you've seen probably in the precious space, some of our peers that are paying 1x net asset value, or in some cases doing a loss leading transaction where they're kind of reliant then on the mine extending its life or gold price ticking up to actually make a return. So we feel like we're able to do this on a much sounder fundamental footing in the sense that we're buying producing assets in the range of sort of 0.6 times NAV. So, if you're valued at 0.9 or 1x, and ideally as we grow the portfolio and get that diversification, then that multiple increases. But yeah, if you're just valued at 1x, then you're seeing a commensurate sort of uplift to what the gold guys are getting when they're being valued at 1.5, but they're buying assets at 1 or 1.1x. So it's in some ways a very similar approach, but we're getting a lower entry price, which allows us to not be reliant on a sort of royalty company premium type valuation. We can be valued, as I said, at 1x, and you're getting a commensurate style uplift. And on development stage assets, we're looking at stuff anywhere from sort of as low as 0.1x NAV. And obviously that's where you get a real kicker in royalty company value, is when that asset then does turn on down the track and then it's being valued at 1x, you see a huge uplift in value.
Okay, now the company's been operating a few months now. You raise money, you've got cash flow. How do you see the company growing, and what is the sort of ideal or the company sweet spot for a deal? What kind of deal size is the sweet spot for you at the moment?
Yeah, I mean, I think with regards to deal size, we can be relatively flexible because we've got all those tools I mentioned, the cash on the books, and then, potential debt capacity and the ability to use equity. So it probably gives us a bit more purchasing power than you probably suspect from looking just at the market cap or just cash on hand. So, I'd say our sweet spot is probably the 5 to 15 range if you force me to put a number to it. But that said, if a $30 million transaction came down the road, we had the ability to raise debt against it and to use our equity as part of the purchase consideration, there's no reason we couldn't pursue an opportunity like that. And indeed, we are looking at some larger transactions that would be pretty transformative. And those sort of deals tend to have a sort of a higher miss rate with regards to deal execution. But yeah, that said, we're not constraining ourselves in that regard because, we do see a number of opportunities, and we're conscious that the fact that this space in the royalty sector hasn't been tapped into, both the geography and the commodity diversification, we want to capitalize on that sort of as quickly as we can, because I don't doubt that other competitors will get into the space if we sort of sit on our heels.
Does that sweet spot give you a certain competitive advantage against some other companies? The bigger companies are chasing bigger deals, so things in that sort of $15 million range may be too small for them.
No, absolutely. Yeah, I mean, you'll see even the mid tiers often most of them don't dip below sort of the $20 million ticket size. As you said, it just doesn't move the needle for them. If they're looking at a royalty, just using hypothetical numbers, but buying a $5 million royalty that's going to pay you $1.5 million a year for 10 years, that could be a great deal for us and very accretive for our shareholders.
Okay, excellent. Well, thank you very much, Adam, for the update about Trident royalties. This is Paul Harris from Mining Journal. Join us on mining-journal.com for more leader interviews.